What if I told you the single best investing strategy is to deliberately buy at the worst possible time? Over and over again. Not when the market dips, not when the experts say so, not when your gut tells you it's safe, every single month like clockwork. Whether the market is up, down, or sideways. By the end of this video, you'll understand why this counterintuitive approach has quietly built more wealth for ordinary people than almost any other strategy, and why the people who try to time the market usually end up with less money than those who just showed up consistently. But here's the thing. Most people screw this up without realizing it. They think they're dollar-cost averaging when they're actually doing something completely different, something that costs them thousands. Let me show you what I mean. Imagine you invested $1,000 every month into the same investment for 10 years. Some months you buy when the price is high. Some months you buy when it crashes. You don't check, you don't stress. You just buy. Now imagine your friend, let's call him Marcus. Marcus is smart. Marcus reads the financial news. Marcus waits for the dip. He tries to buy low and sell high because that's what everyone says to do. After 10 years, who do you think has more money? If you said you do, the one who just bought every month without thinking, you'd be right. And it's not even close. This isn't a theory. This isn't a motivational quote. This is math, and it has a name. Dollar cost averaging. Here's how it actually works. Month 1. You invest $500. The price per share is $25. You get 20 shares. Month 2. Market drops. Price is now $12 per share, same $500, but now you get over 41 shares. Month 3, market crashes harder. Price is $8, $500 gets you over 62 shares. You see what's happening? When the price drops, your same $500 buys you more shares. You're basically getting a discount without even trying. Then when the price eventually recovers, and historically it always does, you've got way more shares working for you. This is the part most people miss. They focus on the price. But the price doesn't matter as much as how many shares you own when that price goes back up. Now let's talk about the psychological side, because this is where dollar cost averaging becomes almost like a superpower. When the market crashes, and I mean really crashes like March 2020, most people panic. They sell. They freeze. They check their portfolio 15 times a day. But if you're dollar cost averaging, a crash is literally the best thing that can happen to you. You're getting shares on clearance. Think about it like this. If your favorite coffee shop put their best beans on sale for half price, would you be upset? No. You'd stock up. That's exactly what a market crash is for someone who invests consistently. A sale. Now let me show you some real numbers, because I know "trust me it works" isn't enough. Let's say you started investing $500 a month in January 2000, right at the peak of the dot-com bubble. Literally the worst time to start investing in modern history. The market crashed, then it crashed again after 9/11, then the 2008 financial crisis hit. It was basically a lost decade. But if you kept investing $500 every single month through all of that, by 2020, you'd have over $230,000. On just $120,000 in total contributions. You nearly doubled your money during one of the worst 20-year periods in market history, because dollar cost averaging turned those crashes into opportunities. Okay, so if this is so great, why doesn't everyone do it? 3 reasons. First, it's boring. We've been conditioned to think investing should be exciting. Day trading, crypto, meme stocks, the thrill of the win. But wealth isn't built on excitement. It's built on boredom. Second, it requires patience. And we live in a world that rewards instant gratification. Dollar cost averaging doesn't show you dramatic results in a month or even a year. It's a 5-year minimum strategy. It's a 10-year strategy. It's a rest of your life strategy. Most people can't handle that. They want results now. Third, and this is the sneaky one, most people think they're dollar cost averaging when they're actually market timing in disguise. They invest monthly, but only when things look good. They skip a month when the news is scary. They double up when they feel confident. That's not dollar cost averaging. That's market timing with extra steps. And studies show that market timing fails about 80% of the time. True dollar cost averaging means you invest the same amount on the same schedule, regardless of what's happening. You automate it, and you forget about it. So how do you actually set this up? Let's keep it simple. Step 1. Pick a broad, low-cost index fund or ETF, something that tracks the whole market, not individual stocks. Step 2. Decide on an amount you can afford to invest every month, even if it's $50. Start where you are. Step 3. Set up automatic contributions. Same day every month. Automatic. No thinking required. Step 4. Do nothing. Literally nothing. Don't check your portfolio every day. Don't read panic headlines. Don't change your plan. That's it. That's the whole strategy. Now, I want to address something I hear a lot from millennials especially. But I don't have enough money to invest. Or, I have student loans. Or, the market is too high right now. Listen, you don't need thousands of dollars to start. Most brokerages now let you buy fractional shares with as little as $5, and the best time to start dollar cost averaging isn't when the market is low. It isn't when the market is high. It's now. Because the whole point of this strategy is that the timing doesn't matter. The consistency does. Let me give you one more example to really cement this. Sarah starts investing $200 a month at age 25. She does it for 10 years, then stops completely at 35. Total invested, $24,000. Her brother Mike starts at 35. He invests $200 a month for 30 years until he's 65. Total invested, $72,000, 3 times as much money invested. At age 65, Sarah still ends up with more money because her money had 30 extra years to grow because she started earlier, even though she invested way less. That's the power of combining time with consistency, and dollar cost averaging is the simplest way to be consistent. So here's what I want you to take away from this. Building wealth isn't about being the smartest person in the room. It isn't about finding the perfect stock. It isn't about timing the market perfectly. It's about showing up, month after month, year after year, letting the math do the heavy lifting. Dollar cost averaging works because it removes the one thing that destroys most investors: you. Not in a mean way, but in a human way. It removes your emotions from the equation. Your fear, your greed, your tendency to buy high because everyone's excited and sell low because everyone's panicking. You just invest, automatically, consistently, boringly. And then one day you look up and realize you've built something real. If this was helpful, there's probably someone in your life who needs to hear it. Feel free to pass it along, no pressure. And if you want more like this, the channel's always here.